Hi there. This is Craig Webb of Webb Analytics, and this is the waterlogged October edition of the Webb Analytics Economic Update. I'd like to thank ECI for making this report possible. This month's takeaways are a little dour in the sense that because of the two hurricanes that we just had, things are going to be a little bit more challenging than they might have been solely if we had had the good news from the Fed of cutting interest rates. We're going to talk a little bit about product shortages, long-term, short-term impacts of the hurricane, as well as the fact that the economy still in general is doing fairly well. The satellite images are really showing the dramatic impact that we've had from the two hurricanes, Helene and Milton. For example, this before and after shot of Florida just gives you a sense of how much work is going to have to be done. CoreLogic estimated that Helene caused 30 to $47.5 billion worth of damage. And because of the lack of flood insurance up in North Carolina, 20 to $30 billion of that was uninsured. And then when you start looking at Milton, which we're still really checking the impact of, it could be at least $100 billion, which is one of the worst that we've ever had. Now, historically, up until about 2021, according to the Harvard Joint Center for Housing Studies, disaster repairs were about 5% of all home improvement spending in any given year. Certainly, we're going to see that share rise in the next few years because of all the disasters we've had. We had 28 of them in 2023 that cost us at least $1 billion. And the average over the years was about 20. Well, we had 20 through August of 2024 this year, and that doesn't even count the stuff that we've had since August. Now, we'd have a better count, except that the people who do that counting are in Asheville, North Carolina, and so they can't really provide those kinds of numbers like right now, like we would prefer. So, short-term impact of Helene and Milton. Product shortages? Yes. Price hikes? Quite probably. We were going to be having price hikes anyway. And even some of the economists from places like Zonda and John Burns Research and Economic Consulting were predicting that we were going to be having price hikes, especially in the areas for which hurricanes are most likely to be causing the need for new products, roofing, drywall, things like that. We're also going to be seeing longer delivery times. Some of you may have heard that Interstate 40 between North Carolina and Tennessee is out of action. So is some other interstates. And basically, if you want to get from, let's say, Charlotte to Knoxville, you're going to have a long, long drive just to get your products somewhere. So if you're in those areas, or your trucks normally would go through those areas, we're going to be having some challenges, and that's going to affect your ability to get served. Longer term, I think one of the bigger factors that we're going to have involves insurance. Certainly, if you go to places like Florida, they've been having insurance issues as a result of storms and other things for quite a while. This chart showing changes in the average payment since 2019 shows a huge number of Florida locations where the prices have gone up way more than the national average. Those are all the bars that have stars at the bottom. And you can see the national average is 52%, but if you're in Jacksonville, it's nearly 90%. And certainly that is likely to continue just because we have so much more damage down there now. The other change that I think we're probably going to be seeing long-term is going to be codes. Now, Florida already has a pretty good wind code, but when you start thinking about how some of the major damage from Milton was not the hurricane coming in to the West Coast, but rather the tornadoes that were damaging other parts of the state, you can see that even places like Florida, which have been pretty good on these kinds of codes, are going to have to revise things. Other parts of the country are going to be probably facing a bigger, ruder awakening. This is a map of riverine areas, rivers that could flood and where the dangers are. And that is going to probably figure more into uh, people's requests that we have more flood insurance and more FEMA payments and the like. And it's not as if it hasn't been, these maps haven't been there before. They just haven't really been noticed or looked at. You know, the mountain areas of Western North Carolina have relatively high flood insurance or flooding dangers. But a lot of evidence indicates that there's no more than about 1% of the homes there that did have flood insurance. What's the net result? There's going to be a lot of people who are going to be hurting for a long, long time in Western North Carolina. And if they rebuild, it'll be interesting to see if the carriers will demand that they start getting FEMA insurance to cover flooding, just like people in Eastern North Carolina do already. Now, normally, I would be leading the news with these people, the Federal Open Markets Committee at the Federal Reserve, who cut their lending rate by 0.5 percentage point. That's something that we've all been waiting for. We've been hoping it would be a big deal. And it's beginning to seem now that it's not necessarily going to be quite the godsend immediately that people had thought. In fact, if you even look at the interest rates for 30-year mortgages since the Fed acted, they've actually gone up recently. They had been down as low as 6.1%. Now they're back up to about 6.6%. Now, interestingly, you know, does it really matter if you're at 6.1 or 6.6? Well, if you're a homeowner, probably not, because something like 86% of all Americans with mortgages are paying less than 6%. So it's going to take a while. In fact, a lot of people believe that we have to get really down to about 5% or lower before we start seeing major impacts of lower mortgage rates. And that is something that is probably going to take at least a year, according to some economic forecasts. When you look at construction, on the single family side, we did see a nice upturn in starts in the most recent month, but places under construction are still slowly going down, and permits, those early indicators, are still declining a little bit too. Multifamily, everybody knows, has been in a slump almost ever since the Fed started increasing interest rates a couple of years ago. We did have a long tail of projects that were underway that kept us busy, but now those projects under construction are continuing to drop, and we're seeing less activity on that front. Interestingly, though, we have more people involved in the construction industry in terms of wage and salary workers than we've had since July of 2007. And the unemployment rate for residential construction workers is only 3.7%. What this gives rise to is the question that a lot of people are believing that if we even were to have better conditions for home building, would we be able to find the workers to do that work? Certainly, with all the concerns we've been having lately about immigration and a whole bunch of other things, the general lack of interest in getting in construction. There are questions as to whether we actually could rise dramatically, even if we did have all the fiscal stimuluses in place. I could give you a slew of forecasts. I'll just give you a few of them that have come from conferences that I've attended recently. The National Association of Home Builders believes that we're going to bump up a little bit above 1 million starts in 2025 from maybe about 950,000 right now, and then continue to rise. Multifamily actually will be a little better this year in 2025, but that's because we went down so much in 2024. On the remodeling side, you can see that most of the forecasts we're getting are relatively modest, you know, maybe up 2%. And some people are actually saying down this year and then modestly up next year. Zonda is more down this year, but more up next year. So we've got different ideas about what's going on, but none of them are going above mid-single digits. Nobody is really predicting a real boom. Uh, the if you count the disaster relief, maybe that would figure in, but actually that money can take a long time to come in. Frequently, if you have tornado disasters in other places, it can take 6 months at least for money to start arriving. And that's if you have insurance money to begin with. The Harvard Joint Center for Housing Studies also points out that your remodeling prospects also vary based on where you live. They're saying certain parts of the country that are going to see bigger increases over 5%. Other places aren't going to do anywhere near as well. So regionalism matters a lot. There is a glimmer of good news on the remodeling front when it comes to mortgage financing. John Burns Research and Consulting points out that 13% of all recent mortgage rate locks, where people were getting the exact amount they needed, also included some cash out. And usually when you do a cash out refinance, that is a sign that you're going to start spending that money to work on the house. Remodeling also can, in a sense, take heart that we've continued to have a slowdown in monthly sales of existing homes. The notion is that if people are staying in their homes longer, they're not moving, that they're probably going to want to fix up their home. So that's also, in a sense, a mildly encouraging note. Now, all of this is going on, this relatively sour news involving the housing economy, at a time in which the overall economy is growing fairly well. I mean, we had a 3% increase from the second quarter from the first, and according to GDP Now, which is a sort of a predictive tool that the Atlanta Federal Reserve uses, they think that we're probably going to be about the same, maybe about a 3% increase in the quarter that just ended. With October, we've begun the fourth quarter. The third quarter was actually pretty good, certainly much better than the blue chip economists were predicting. When it comes to you're looking at the economy in general and then compare it to past comebacks in previous business cycles, the Hamilton Project, which I believe is part of one of the think tanks here in DC, looked at the various cycles, and the one that we're in right now is the one that's the orange bar. And you can see that, in effect, we grew much faster earlier than the other business cycles. And you can say, well, that's because of the stimulus money that we put into the economy. So that enabled us to get out of it. And in fact, good spending on goods is up 19% over the past 18 quarters. During the Great Recession, the one of the around 2007, it took us 36 quarters to get that kind of growth. Now, it has slowed down. You can see that our orange bar is not, way ahead of everybody else right now. But we got there faster, and now it seems like we're going to be in. It seems like we're going to continue to grow, but not necessarily at the rate that we were in the past. A lot of people have been concerned about inflation, but the overall inflation rate, when you talk about year-over-year changes, continues to go down from that dramatic peak that we had in July of 2022. And people's earnings continue to grow at a faster rate than the inflation is. So theoretically, you would think that people were feeling better, but we've got that vibe session going on in which people are worried about the economy and all the accumulated increases in prices that we had earlier this decade. Shelter is really continuing to be the major driver of whatever inflation we have. It's still going up. It's at a slower pace than it used to, but if you look, that the September CPI was 2.4%, but shelter was 5%, you can see that housing prices are going to continue to be that challenge, and affordability is going to continue to be a challenge as we go forward. And I think it's because of those kinds of things that when Zonda was talking to pro contractors, They said that in the summer of this year, in July, they were seeing a big increase in the number of customers who were pushing back overpricing of jobs compared with previously. And so that was an indication, I think, of some of the concerns that people were having in general about the economy. Another decent sign about the economy has to do with how many goods we're getting into the country, the shipping that's coming in. Obviously, if you're a retailer, if you had been worried that people weren't going to be buying this holiday season, you wouldn't be bringing in so much stuff. But those light blue, those teal colored bars are all exceeding what we had in 2023, and they continue to exceed. And so that would be an indication that things are fairly optimistic on the retail side. They were a little bit nervous about the longshoreman strike, so that may have pushed things up a little bit earlier than normal in August and September. But in general, they're still feeling optimistic about where the economy is going. So let's review once again what's happening. We're going to have short-term impacts in terms of prices and availability of products as a result of the weather disasters. As we're also going to be seeing medium-term impacts with regard to higher insurance rates, especially in places like Florida and other hurricane-struck areas. The longer term, I think, will be code changes that we're going to be looking at as legislators and insurers are going to say, we just can't keep going on the way we are. The Fed rate cuts were welcome, but they seem to be having a relatively modest impact on the market. Most of the forecasts that we have for home building and remodeling in the coming year are modest at best. And despite all this, all those relatively bad things, the underlying good news is that the overall economy keeps chugging along. And we're growing at 3% a year, which certainly, given the fears that we had of recessions a few years ago, that ain't bad at all. I used to say that people were positively nervous about the economy and that they were positive and doing better than the economy. I think the economy today for building material dealers is like being on a paddleboard. You're not getting any propulsion from the housing industry or the remodeling industry. If you want to grow, if you want to get better, you've got to do all the work yourself. You got to provide your own propulsion. But for those who are clever and ambitious and have some pretty good programs underway, they are seeing that growth. It's not certainly what we were when lumber prices were going crazy, but we are seeing some people still do well. If you are just counting on other forces to keep you moving along, I think you do have challenges. My job, of course, is to help you spot those challenges and those trends and threats and opportunities. So I hope you enjoyed this report. Once again, ECI made it possible. I hope you had a good day, and I will talk to you again next month. Bye-bye.